Hey everyone, welcome back to Corporate Decoder. Today, RDAGW just filed their Q1 10Q report, and I am seeing some interesting shifts in their cash position. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is still working towards a business combination and has some key financial numbers we need to unpack. This is a filing from Republic Digital Acquisition Company, a special purpose acquisition company or SPAC, that is looking to merge with another business. They file these quarterly reports called 10QS to keep investors updated on their financial health and operations. Let's dive into their balance sheet right away. On the 31st of March 2026, the company had cash of about $868,000. That is down from about $1 million at the end of December 2025. So their cash on hand actually decreased a bit in the first few months of 2026. Now, a big part of any SPAC's balance sheet is the money they set aside in a trust account. This is usually the bulk of their funds, meant to be used for acquiring a target company. As of the 31st of March 2026, this trust account held over $310 million. This is up from around $308 million at the end of 2025, showing a slight growth in their trust investments. This next line item is really important for SPACs. It shows the Class A ordinary shares that can be redeemed by shareholders. The redemption value per S-share was around $10.36 on the 31st of March 2026, up from about $10.27 in December 2025. This mirrors the growth in their trust account investments. This means that if shareholders decide to redeem their shares, the company would need to pay out more per S-share than it did at the end of last year. And here is something to pay close attention to. The company has an accumulated deficit. On the 31st of March 2026, this deficit was almost $11.8 million, growing from about $11.6 million at the end of 2025. This deficit signifies that the company has spent more money than it has earned since its inception, which is typical for a SPAC before it completes its business combination. Looking at their income statement for the first quarter of 2026, we see a net income of about $2.5 million. This looks good at first glance, but it is mostly driven by earnings from their trust account investments. They also reported general and administrative costs of about $165,000 for the first 3 months of 2026. This is much higher than the roughly $48,000 spent in the initial period from January 2025 to March 2025. This increase is expected as the company ramps up its operations and searches for a business to acquire. The biggest contributor to their net income was earnings from their trust account investments, which brought in over $2.7 million in the first quarter of 2026. This is a crucial income stream for them right now, as they do not have operating revenues. For Class A ordinary shares, the basic and diluted earnings per S-share was about 7 cents in the first quarter of 2026. This is calculated on 30 million shares, which is a clear number to track. For Class B ordinary shares, which are typically held by founders or sponsors, there were about 7.5 million weighted average shares outstanding. Their earnings per S-share was also 7 cents in the first quarter of 2026. This shows how the profits are shared between the different classes of shares. Moving to the changes in shareholder deficit, at the start of 2026, the company had a deficit of about negative $11.6 million. During the first quarter, they had to account for the increased redemption value of Class A shares, which reduced their equity by about $2.7 million. This is an accounting adjustment reflecting the rising redemption price. By the end of March 2026, their total shareholder deficit grew to nearly negative $11.8 million. Now let's look back at the very beginning of the company's life, from its inception in January 2025 through March 2025. Here we see the issuance of Class B ordinary shares to the sponsor, totaling over 7.5 million shares. This was part of their initial setup. During this very early period, the company reported a net loss of about $48,000, which is pretty standard for a company just getting started. By the 31st of March 2025, their total shareholder deficit was about negative $23,000. Now for the cash flow statement for the first 3 months of 2026, the company used about $147,000 in operating activities. This outflow is mainly due to the slight decrease in their cash balance and changes in their operating assets and liabilities. Interestingly, the earnings from their trust account investments, which were over $2.7 million, are subtracted here. This is because these earnings are considered investing activities for cash flow purposes, not operating. Essentially, their core operations are still burning cash, but that is offset by the income generated from their trust account investments. Back in the first period from January to March 2025, they had no net cash used in operating activities. This makes sense as they had just started and had very minimal expenses. The company's main goal is to find and merge with a business. They were incorporated in the Cayman Islands on the 23rd of January 2025, and they have not yet identified a specific target. A key deadline for SPACs is the combination period, which is the time they have to find and complete a merger. For a public digital acquisition company, this period is until May 1, 2027. If they do not complete a business combination by then, they will have to liquidate and return the money in the trust account to shareholders. This is a critical pressure point for them. As an emerging growth company, Republic Digital Acquisition Company can take advantage of certain exemptions from reporting requirements. This can make it a bit tricky to compare their financial statements directly with other public companies, as they might be using slightly different accounting rules. This section explains how they account for the class of shares that shareholders can redeem, because these shares can be redeemed under certain circumstances not entirely within the company's control. They are classified as temporary equity. This means any changes in their redemption value are recorded immediately, impacting their equity accounts. They also detail how they calculate earnings per S-share for their two classes of shares. For the first quarter of 2026, both Class A and Class B shares saw about 7 cents in earnings per S-share. Republic Digital Acquisition Company had its initial public offering on May 1, 2025. They sold 30 million units, with each unit containing one class, a share, and half of a redeemable warrant. The IPO raised $300 million. Simultaneously with the IPO, they also completed a private placement, selling 7.28 million warrants to the sponsor and underwriters for $1 million. These warrants are similar to the public ones, but have some restrictions on transfer. This section talks about transactions with related parties, primarily their sponsor. It details the issuance of Class B founder shares to the sponsor and also mentions an IPO promissory note. These are common elements in SPAC formations. The sponsor provided a loan under an IPO promissory note which was non-interest bearing. A total of about $294,000 was outstanding and was fully repaid upon the closing of the IPO. This part of the financials breaks down their shareholder equity, or in this case deficit. They have authorized preference shares, Class A ordinary shares, and Class B ordinary shares. As of the 31st of March 2026, there were 7.5 million Class B shares outstanding, which are the founder shares. There were over 22 million warrants outstanding as of the 31st of March 2026. These warrants can be exercised to buy Class A shares. They become exercisable 30 days after the business combination is completed and expire 5 years later. An interesting point here is that the company can redeem these warrants if the Class A share price reaches $18 for a certain period. This is a common feature designed to encourage the exercise of warrants or force a redemption. They use a 3-level system to measure fair value. Level 1 uses quoted prices in active markets, Level 2 uses observable inputs, and Level 3 uses unobservable inputs. Their investments in the trust account, primarily money market mutual funds, are valued using Level 1 inputs, meaning they rely on readily available market prices for identical assets. This shows a high degree of transparency in valuing these holdings. Now let's look at management's own discussion. They acknowledge they are an early stage company and expect to continue incurring significant costs in pursuit of their acquisition plans. This reiterates the crucial deadline of May 1, 2027 to complete a business combination. Failure to do so will result in the liquidation of the company. Management confirms the net income for the quarter was driven by trust account earnings, with administrative costs being the main expense. This highlights their reliance on investment income while they search for a merger target. They state that following the IPO and private placement, $300 million was placed in the trust account. They also highlight that they incurred significant fees related to the offering, including a deferred underwriting fee. Management believes they have enough funds to operate until a business combination. However, they acknowledge that if acquisition costs are higher than expected, they might need more financing. This statement is typical for SPACs, but always worth noting. As a smaller reporting company, they are not required to provide extensive disclosures on market risk. The company's management has assessed their disclosure controls and procedures and concluded that they were effective as of the 31st of March 2026. This is a standard procedural statement. Finally, the filing includes various exhibits, including certifications from the CEO and CFO and XBRL filings, which are standard for CSE reports. So what is my take on this filing? Republic Digital Acquisition Company, or RDAGW, is in a critical phase. Their financials show a solid amount in their trust account, which is growing thanks to investment income. However, their operating expenses are also ticking up and their accumulated deficit is widening. The biggest concern for any SPAC investor is always the deadline to complete a business combination, which for RDAGW is May 2027, not a ton of time. They have a strong team background in fintech and crypto, which could lead to a good acquisition target, but the clock is ticking. The risk I am watching is how effectively management can deploy that trust account capital before the deadline, especially given the current market environment for SPACs. Oh, and if you want to know about the tools I utilize for these analyses, they are linked in the description below. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.